Most Australians dream of retirement, yet few realise they're leaving millions on the table while your money sits in a default superannuation fund earning modest returns. A select group of wealthy Australians quietly deploy a strategy that transforms retirement savings into personal wealth-building machines. What if that machine could be yours? What if your retirement fund wasn't just a safety net, but a sophisticated tool for creating the lifestyle you've always wanted? This is the story of the self-managed super fund, a financial secret the wealthy have known for decades but rarely discuss at dinner parties. Over $800 billion sits in SMSFs across Australia, yet most hardworking Australians have never heard of them. They're not complicated in theory, but they've been shrouded in mystery by the financial industry, which profits when you hand your money over and forget about it. The legal framework exists to allow up to 6 members in a single SMSF, though most are smaller. You might run one with your spouse or perhaps with business partners. The Australian Taxation Office has established rules, important guardrails that actually protect your wealth rather than restrict it. These aren't obstacles. They're the architecture that keeps the system functioning and keeps bad actors out. But why should this matter to you personally? Imagine watching your default superannuation earn a 3 to 4% return year after year, while the global wealth landscape offers opportunities yielding 8, 10, or 15% when properly managed. Imagine having the ability to invest in real estate, to diversify across multiple asset classes, to time decisions strategically around your life and tax situation. The wealth paradox is striking. Some of Australia's most successful people, surgeons, lawyers, business owners, entrepreneurs, manage SMSFs, while average workers remain unaware the opportunity exists. Here's where luxury enters the narrative. This isn't about frivolous spending or reckless excess. It's about strategic wealth accumulation that enables genuine lifestyle choices. When your retirement fund compounds intelligently over decades, invested in assets that align with your vision, something remarkable happens. That early retirement becomes feasible. That international property investment becomes possible. That dream of genuine financial independence shifts from fantasy to achievable target. We're talking about leveraging tax-optimized growth to fund experiences and security that most people assume are only for the truly wealthy. The strategies are elegant yet powerful. Through salary sacrifice, you redirect pre-tax income into your SMSF, accessing tax rates of just 15% instead of your marginal income tax rate. For a high earner, this alone saves tens of thousands annually. That tax savings gets reinvested, compounds over years and decades, and multiplies through strategic asset allocation. Property investment within an SMSF operates differently than personal property ownership. You can leverage borrowed funds to amplify returns while the rental income compounds tax efficiently. You can hold diverse investments, shares, exchange-traded funds, even alternative assets, depending on your strategy and risk tolerance. For those with higher incomes, more complex strategies become available, unlocking additional layers of wealth optimization. But let's be honest about the honest part. SMSFs demand knowledge, responsibility, and meticulous compliance. The Australian Taxation Office scrutinizes them more closely than other supertypes. This isn't punishment. It's simply the reality. Audit rates are higher. Documentation requirements are stricter. Related party transactions demand careful handling. This complexity isn't a barrier, though. It's precisely the reason these funds work so effectively for those willing to manage them properly. Before we continue into the specific strategies that separate successful SMSF users from the rest, subscribe to the channel and tell us in the comments where you're watching from. Your perspective matters. And this conversation only deepens when we hear from you. The property play begins with understanding how your SMSF operates differently from personal investment. Within your self-managed fund, you can invest directly in real estate, residential properties, commercial spaces, development land, even holiday rentals. This capability alone transforms your wealth trajectory. Where a regular investor might leverage personal borrowing to purchase a single property, an SMSF structures the investment so that rental income flows back into the fund, tax efficiently, compounding year after year without the drag of high personal income tax rates. Consider a practical framework. Imagine your SMSF holds $500,000 in accumulated savings. Rather than letting that capital sit passively, you explore limited recourse borrowing, a mechanism that allows your SMSF to borrow money for property investment while restricting the lender's recourse to the property itself. Your fund borrows $700,000, combining it with your existing capital to purchase a $1.2 million residential property. The monthly rental income flows into your SMSF, covering the loan repayment and building equity. Over 20 to 30 years, the compounding effect becomes extraordinary. That single decision multiplies your wealth potential significantly. Salary sacrifice amplifies this strategy further. If you earn $100,000 annually, you can redirect a portion of your pre-tax income directly into your SMSF. Rather than receiving that income personally and paying marginal tax rates that climb toward 45% for higher earners, you access concessional contribution rates of just 15%. The mathematics are compelling. A $22,000 contribution that would cost you $30,000 in after-tax personal income costs, only $22,000 when salary sacrifice. That $10,000 annual difference reinvested in your SMSF grows exponentially through compounding over a career spanning 3 decades. This single strategy can add hundreds of thousands to your retirement wealth. For high-income earners, Division 293 introduces an additional consideration. Income above $130,000 triggers an extra 15% tax on superannuation contributions, meaning your total tax rate reaches 30% on concessional contributions. This sounds concerning until you compare it honestly to alternative scenarios. That same income earned personally and invested outside superannuation faces marginal tax rates of 37 to 45%, plus capital gains tax considerations. Even with Division 293 applying, the SMSF pathway remains mathematically superior for wealth accumulation. Doctors, lawyers, and business owners continue using SMSFs precisely because the numbers work despite this additional tax layer. Investment diversification within your SMSF extends far beyond traditional superannuation options. While many default super funds offer a handful of preset portfolios, your SMSF can hold shares in individual companies, exchange-traded funds tracking broad market indices, managed funds with specific strategies, and even alternative assets like cryptocurrency or fine art collectibles within regulatory constraints. This flexibility means you can build an investment portfolio genuinely aligned with your risk tolerance and market outlook. If you believe Australian residential property offers superior returns, you can overweight that allocation. If you prefer international equity exposure, your SMSF can access that. This control represents a fundamental advantage unavailable in traditional superannuation. Limited recourse borrowing extends beyond single property purchases. Sophisticated SMSF strategies involve borrowing to establish diversified share portfolios or multiple property investments across different markets. The leverage works powerfully because you control $2 million in assets while deploying only $500,000 in capital. Market upswings amplify your returns dramatically. This power demands respect, though. During downturns, that same leverage can threaten your position if you've overextended beyond prudent limits. Tax timing and withdrawal strategy form the foundation of the endgame. After age 60, depending on your preservation age, you can access your SMSF in a tax-free pension phase, drawing income without triggering additional taxation. By strategically timing contributions and withdrawals across decades, you optimize your tax position year by year. That compounding wealth, grown through property investment, diversified assets, and tax-efficient contribution strategies, ultimately funds a lifestyle enhanced by careful financial architecture built over your working life. The compliance reality of SMSF management separates dreams from practical wealth building. The Australian Taxation Office scrutinizes self-managed super funds more intensively than traditional superannuation, and understanding this scrutiny transforms it from threat into protection. Audit rates for SMSFs hover significantly higher than other retirement account types, with the ATO prioritizing funds showing patterns inconsistent with legitimate investment activity. This heightened attention isn't punitive, it's preventative. The rules exist to protect your wealth, not threaten it. Common audit triggers reveal themselves through predictable patterns. Excessive benefits extracted by trustees raise immediate red flags. Related party transactions, purchasing property from family members, hiring relatives at inflated rates, or establishing investment arrangements favoring fund members attract scrutiny quickly. Poor record keeping becomes expensive when the ATO questions your documented reasoning. The solution isn't avoiding these activities entirely, it's structuring them transparently with professional guidance and meticulous documentation. Every transaction deserves a paper trail explaining the commercial rationale and fair market valuation. Examining common pitfalls illuminates where people stumble. Mixing personal and SMSF investments creates liability nightmares. Your SMSF exists as a separate legal entity, and blending its assets with personal holdings violates fundamental trustee duties. Imagine borrowing your SMSF's capital for a personal business venture. When that venture fails, creditors pursue SMSF assets, potentially destroying retirement wealth you'd spent decades accumulating. Maintaining absolute separation, separate bank accounts, separate property titles, separate investment records costs nothing but discipline. Inadequate record-keeping ranks equally dangerous. The ATOOB doesn't accept verbal explanations or vague memories. You'll need contemporaneous documentation, investment purchase agreements, property valuations, loan agreements, meeting minutes, recording trustee decisions, and annual financial statements. Professional accountants typically handle this complexity, charging fees that seem expensive until you face an audit without documentation and watch your fund's legitimacy crumble. Paying yourself or family members inflated fees represents another costly mistake. Your SMSF can legitimately employ trustees, accountants, or investment advisors and pay reasonable fees for services rendered. The temptation arises when you pay yourself excessive compensation disguised as professional services. An accountant reviewing SMSF records might legitimately charge $500 annually. Charging $5,000 for identical work triggers investigation and potential fund disqualification. Over-leveraging through limited recourse borrowing can devastate during market downturns. You borrowed $700,000, combining with $500,000 capital to purchase a $1.2 million property. Imagine property values declining 20% while interest rates spike. Your asset drops to $960,000 while your debt remains at $700,000. Your equity shrinks dramatically, and if rental income falls, you may struggle covering loan payments from SMSF resources. Conservative leverage, borrowing no more than 50% of property value, provides safety margins protecting against volatility. Estate planning and beneficiary designation require attention most SMSF trustees neglect. Your SMSF trustee deed specifies who receives benefits if you die before retirement. Outdated beneficiary designations can redirect wealth away from intended recipients. Couples managing joint SMSFs need clear succession planning, ensuring the surviving spouse can continue managing the fund legally. Understanding the cost structure determines whether an SMSF makes financial sense. Setup costs typically range from $2,000 to $5,000. Annual compliance costs, accounting, audit, administration range from $1,500 to $3,000 depending on investment complexity. For SMSF balances below $200,000, these fixed costs consume excessive returns, making traditional superannuation more efficient. The SMSF advantage typically emerges for account balances exceeding $300,000, where annual costs represent smaller percentage drains on wealth. Your next steps proceed methodically. First, assess your current superannuation balance and contribution capacity honestly. Second, consult a licensed financial advisor. This isn't optional, it's essential. They calculate your personal return on investment comparing SMSF benefits against complexity costs. Third, if proceeding, hire a professional SMSF accountant and initial trustee coordinator. Fourth, document everything obsessively from your first SMSF transaction forward. Fifth, commit to annual compliance reviews ensuring your fund remains within regulatory boundaries. The wealthy have wielded these tools for decades because they work. Your retirement fund genuinely can become a wealth-building engine through strategic property investment, tax-efficient contributions, and diversified asset growth. This transformation requires knowledge, discipline, and professional support, but the mathematical advantage justifies that